So, last time we stopped at saying that GDP, which is the gross domestic product of a country, is defined as C, that is the consumption spending of households on goods and services, that is anything that the households would buy like groceries to utilities and stuff like that. Then the investment spending of business firms, that is capital I. So, business firms also spend on goods and services that are produced in this country because they need to buy the raw materials for producing more output. G, which is the government spending on goods and services. Once again, the government also has to buy the goods and services that are produced by a country. Most of these goods are public infrastructure goods, or they could be defense goods. Then there is exports, which is denoted by capital X. Now, exports are the goods that are produced in this country, but are sent from this country to the rest of the world, that is to the foreign sector. So, the exports are the goods that are produced by United States, if United States was our home country, and it is bought by the people residing outside United States in the rest of the world. And we need to take off the imports, which is denoted by capital M. So, M stands for imports, and we need to subtract this from the GDP equation because the households, the business firms and the governments, that is the three sectors of the domestic economy, they are not only buying the goods and services that are produced by USA, but they also end up buying some goods and services that are produced outside USA. For example, if you walk into Walmart, you may buy a good that was produced in Vietnam or that was produced in Indonesia. So, those are goods that came to your country from those countries. They were not produced here in United States. So, they cannot be accounted for in the GDP of United States, and hence those imported goods are subtracted out. Now, this part, the X minus M, exports minus imports, this part is also called the net exports, and it is denoted by NX. So, we could rewrite this equation and say that the GDP of the home country during a certain year is C plus I plus G plus NX, right. Let us say this is the GDP of USA in the year 2018. Then this GDP is also known as nominal GDP, abbreviated as NGDP, where the term nominal, this basically implies that all these goods and services that are included in the GDP are all evaluated at the prices of 2018. So, when we are computing the value of these goods and services, we are including the value at the prices of 2018. Now, try to understand. Let us go back to the GDP definition. The definition of GDP was, it is the total value of all final goods and services produced in this country, and to get to that value we use this equation C plus I plus G, and we got this equation from the 4-sector circular flow model. But if we go back to the very basic definition and concentrate on the word value, then how do we get the value of something? If I ask you what is the value of this pen, then your answer would be whatever price you pay for this pen. So, if I pay $10 for this pen, then the value of this pen is $10. Now, if I had 3 pens like that and I said what is the value of those 3 pens, then you would just do 3 times $10 and you would say the value of those 3 pens are $30. So, basically value implies price in dollars times the units of the good that were sold, that is quantity. So, that gives me value. So, here what I am trying to say is, as we find the GDP of USA using this formula, the C plus I plus G plus NX formula, we are not only looking at the quantity Q for 2018, but we are evaluating those values at the prices that prevailed in 2018. So, that is the meaning of nominal GDP. Nominal GDP is the total value of goods and services produced within the domestic borders of the country evaluated at the prices of that current accounting period. Now, let us go a little bit deeper into understanding this concept of GDP. So, one method for measuring the GDP would of course be finding what is C, what is I, what is G, what is X and M, and putting that into that equation and getting the value for the GDP of a certain year. Now, this method is known as the expenditure method or the spending method. The expenditure method or the spending method for finding the GDP, and the very name suggests why we are calling it the expenditure method or spending method, because what you are really doing is you are aggregating the expenditure or the spending of the 4 sectors of the economy, that is the households, the firms, the government and the foreign sector, and you are getting the GDP number. An alternative method for finding the GDP is called the income method. Okay. Now, this expenditure method and the income method, these are really 2 sides of the same coin, because if you spend something, then obviously you should have got the money from somewhere, you should have earned that money from somewhere if you spend that money on something. For example, if you buy something worth $10, then there should be a source of income for you where those $10 have come from. Maybe you babysat for 1 hour and you got $10, or you waited table at a restaurant and you got the $10 as wages, or maybe you had something that you lent out, you maybe rented out a book for someone for a month and you got the $10. So, all I am trying to say is when you spend something, then the spending, the money that is spent does not come out of thin air. It should have come out of a source. You should have earned that money from somewhere, whatever may be the source of income. So, spending and income are like 2 sides of a coin. If you spend something, then it must have been earned somehow, and if you earn something, then it must have been spent on something later, right. So, if instead of looking at the spending or expenditure, we look at the income of all individuals in the economy, then we should be able to get to that same GDP number, because who are spending on the goods and services? The households, the firms, the government and the foreign sector. So, if we are able to aggregate the income of all people living in this economy, then we should be able roughly to get to a number that gives us the spending on goods and services in the economy. So, the income method is basically getting to the GDP number, but here we are aggregating the income of the people in the economy. So, it would be wages plus rent plus profit plus interest income, any returns that are earned on financial products, interest plus dividends. So, those are the sources of income for anybody living in this economy. Someone could earn wages or salary, someone may be leasing out or renting out something and earning rent, someone may be having a business firm and making profit, someone may be investing in financial products and earning interest, and someone may hold stocks and bonds and may be earning dividends. So, broadly speaking, you could divide the sources of income into wages, rent, profit, interest and dividends, and when you sum up all the wages, all the rent, all the profit, all the interest and dividends earned by the residents of a country, then it roughly gives you the GDP number, because all that income eventually gets spent on goods and services that are produced in the economy. So, the income and the expenditure method are roughly similar in the sense that they should numerically give you the same number, that is the nominal GDP of the country. However, there may be some discrepancy, there may be some numerical discrepancy, and that discrepancy is known as statistical discrepancy or SD. statistical discrepancy or SD. So, SD is basically the deviation of expenditure method number that you get for GDP and the income method number that you come up for GDP. They should be theoretically the same, but in the real world there happens to be some numerical deviation or numerical discrepancy, and that is called statistical discrepancy. Now, smaller the statistical discrepancy, the greater is the reliability of the measure for GDP. If you have a smaller deviation, it means that the method for collecting the information, you can understand that for the whole economy, for a big macro economy, it's really a tedious process to collect all this information, right. So, smaller the deviation, it means that the method is more foolproof and greater is the reliability of the method. Higher the statistical discrepancy, there is more reason to doubt the numbers then if you come up with really varying numbers by the two methods, and this is kind of intuitive. So, the more developed a country is, the lesser is the statistical discrepancy, and the more underdeveloped a country is, the higher is the value for statistical discrepancy, which means that developed countries have relatively more reliable numbers for economic indicators like GDP, whereas developing countries have a relatively unreliable measures. For example, China, India, they have been talking so much about the growth rate of their GDP and really big numbers like 7%, 8%, but if you look at the statistical discrepancy, then for those countries the statistical discrepancy is also super high, which kind of makes us raise our brows and say, okay, can we really trust those numbers? All those claims that those countries make for really high GDP, you have to take it with a pinch of salt, because they also have a very high statistical discrepancy. Whereas for a developed country like United States or maybe for Germany, the statistical discrepancy is relatively much smaller, which makes us trust those numbers a little more. Now, who is doing all this calculation? For United States, all this calculation for GDP, and this is being done because they want to track the health of the macroeconomy. If you remember for last time, the whole point that we were looking into this is because we wanted to evaluate or monitor the condition, the macroeconomic condition of the country. So, someone must keep tab on all this, and that someone is the Bureau of Economic Analysis in United States. Every country of course has a different agency. For United States is the Bureau of Economic Analysis, also called BEA. If you are curious, you might Google the website of Bureau of Economic Analysis and you will get more hands-on details on how really the process of collecting information for GDP is done in this country. Now, moving forward, so we talked about two methods for getting the GDP number, the expenditure method and the income method. Next, we need to talk about another method. Now, please remember that these two methods are the more important methods for GDP calculation, or the more widely used methods for GDP calculation. Nevertheless, we should also know about a third method, but in United States that is not a very widely used method for GDP calculation. However, in some other countries that could be more popular, but we should know about, theoretically we should still know about that method for GDP calculation. Okay, so the third method for measuring the GDP is the value added method, abbreviated as VAM, the value added method. Now, the value added method is really a method which is important in order to avoid double counting in GDP calculation, right. So, again let me take you back to the definition of GDP. Please note that the definition of GDP states that it is the value, it is the total value of all final goods and services produced within the borders of the country during an accounting period. So, I am stressing on the word final. Now, final goods and services means that the final product that is sold to the customers, to the consumers. Now, for every final product there are always some intermediate products. Another way of looking at the intermediate products is basically the inputs or the resources that go into making the final product. For example, if this pen is the final product, then the ink that went into it is the intermediate good, the plastic that was used is the intermediate good, because those are the ones that went into, those are the inputs that went into making this final product. But you know, every intermediate product is also the final product for some other seller, right. So, if this pen uses plastic, then that plastic must have been produced by someone. If this uses ink, then that ink must have been produced by someone. So, every final product actually includes some intermediate products, but those if you backtrack, then those intermediate products are also final products for someone. Let us kind of take an example and try to understand this. So, let us say, you know, the final product is bread. So, bread is what is sold to the customers or consumers, and say the price of this bread is maybe $5. Okay, it could be any value, but I am just cooking up this number and saying it is $5. So, if I have to include the commodity bread into GDP, then I would just include the value of the final commodity, that is $5, into the GDP, that goes to GDP, right. But the bread includes several intermediate stages of production. With the bread that is sold at the retail store, maybe at Walmart, has not, you know, dropped from the air. Someone must have produced the bread. So, there are some stages in the chain of production for bread. For example, the farmer must have grown the wheat, and the farmer must have sold that wheat to the miller, and this is a very simplified version of the example. So, the miller bought the wheat and must have ground the wheat to make the flour, and then the miller must have sold the flour to the baker, and the baker must have converted the flour, must have baked it into bread, and then the baker must have sold it to the wholesaler, and the wholesaler must have taken it to the retailer, taken it as in sold, and the final product bread then gets sold to the customers. So, there are different stages in the production or different stages in the value chain for a final commodity. Now, please note that the wheat, the flour and the bread that is sold by the baker to the wholesaler and finally to the retailer, these are not final stages of the production. These are intermediate stages of production. However, if you just single out every stage, if you call this stage 1, if you call this stage 2, stage 3, stage 4 and so on, if you just single out one stage, then at stage 1 wheat is the final product, right, because the farmer is growing the wheat, he is sowing the seeds, using fertilizers, maybe using, you know, whatever irrigation, using tractor and all of that for his farming, but the final product that he churns out is wheat, right. If you look at stage 2 and you just single out stage 2, then the miller, he must have ground the wheat, he took the wheat, so the wheat was his resource or input, he took the wheat, put it into a machine, used a machine and he ground the wheat to get the flour. But at his stage, flour is the final product. Going down stage 3, the baker must have used the flour and he must use his baking utensils, he must have used his oven and all of that to finally bake the bread. But at that stage of production, his final product was the bread. So, all I am trying to say that if you just look at the big picture, if you just look at stage 5, then bread is your final commodity, but if you track back, then there may be various stages of production of bread, and at every stage you are able to single out a final product at that stage, right. So if we said that we were going to include the value of all final goods, then you would be adding the value of wheat plus the value of flour plus the value of bread that the baker bakes plus the bread that the wholesaler sells, and again the value of the bread that is sold to the customer. So basically what you would be doing double counting, triple counting and multiple counting of final goods, right? So in order to avoid that confusion, we stick to the definition of final good and we only include the value of the final good at the last stage of production, or the alternative way of doing that is the value added method, where we calculate the value added at every stage of production. So for stage 1, we will calculate the value added of stage 1, which will be the selling price of stage 1 minus the cost of inputs. So that is the definition or formula for calculating value added. Value added is the selling price SP, so this will be a dollar value, minus the cost of inputs, which will also be a dollar value. So what we are trying to say is, for the farmer, for his wheat, the value added is the selling price he gets by selling his wheat to the miller, whatever price he sells it for, minus the cost of his inputs, for example maybe seeds, fertilizers, etc., whatever he has required for growing wheat, right? That is the farmer's value added, and you end up getting a number for that value added, VA1. Similarly for stage 2, you can get the value added for the miller, right? So that will be the selling price of the flour which the miller sells to the baker, because that's his final good, minus the cost of his input. So it must be the cost of the wheat that he bought from the farmer. That's his input, right? And you end up getting a number for that value added, right? Similarly for the baker, you get a value added for that stage. So this must be the selling price of bread to wholesaler minus the cost of his input. So basically the cost of the flour that he bought from the miller, and you end up getting a number for that. Similarly, you will get a number for the wholesaler, and finally you will also get a number for the retailer. So the alternative method would be to add these value added. So what I am saying is, basically you can get the value of the bread by doing VA1 plus VA2 plus VA3 plus VA4 plus VA5. That means just adding the values added to the product at every stage of production. That's an alternative method. So one way would be just take the selling price of the bread. But there is a problem, because when we say final goods, you often end up calculating the value, taking in the value of all final goods. That means you are risking double counting or multiple counting. And so to avoid that, you just figure out the value added at every stage of production and you add up the value added. So that way you are avoiding the problem of double counting and triple counting by doing this. So value added method, the simplest definition would be, the value added method gives you the GDP by aggregating the value added to the good at every stage of production. So here we have 5 stages of production. We have calculated the value added at every stage and added them up to get the value of the commodity, which should actually go into the GDP. Now once again, by looking at the example and hearing about this, you can understand that once again this is going to be a very tedious process to calculate for the zillions and zillions of commodities and services that are produced in the country. And that's why this is not a very apt method for calculating the GDP. The easier methods, the relatively easier methods, are the expenditure or the income method. However, for the purpose of this class, you should theoretically know what the value added method is, and you should know how to calculate the value added for a commodity. So, the formula for value added is basically the selling price of the good minus the cost of all inputs, the total cost of all inputs. So, we talked about three methods for calculating the GDP: the expenditure or spending method, the income method, and the value added method. Okay. So, we talked about these three methods which give us the nominal GDP, abbreviated as NGDP. Okay. Now, next let us talk about what are the goods and services that do not get included into GDP. So, GDP only includes the final goods and services produced within the geographic boundaries of the country. Now, are there any other exclusions from GDP? Now, let us talk about those exclusions from GDP. Okay. The first two follow directly from the definition of GDP. So, first you exclude goods produced outside home country. So, in this case our home country is United States. So, that means you exclude all goods that were produced outside United States. Nothing goes into the GDP of USA if it was produced outside. It may be sold in USA, but if it was produced outside USA, then it is not included in US GDP. So, any goods that are made in China, made in India, made in Philippines, they may be sold here, they may be bought by US citizens in United States, but they do not get included in the GDP of United States. Secondly, any good that is intermediate. So, intermediate goods get excluded from GDP. For example, the same example of bread. If you are talking about bread, then in case of bread, the flour does not get included in GDP, right. In case of car, for example, the value of the car goes into a new car, the value of the new car goes into GDP, but for example, the value of the engine that you put into the car, the value of the windshield, or the value of the audio system in the car, that does not go into GDP, because those are only smaller parts or intermediate goods that make the final commodity. So, only the value of the final commodity gets included, but the value of the intermediate good does not get included in the GDP. Now, here there is a small disclaimer. Now, let us understand the process. What is some of those intermediate goods may get included into GDP if it is a capital good. For example, in case of the baker, right, if the baker is selling a loaf of bread, then the value of the flour that goes into making the bread does not go into GDP. However, the value of the maybe the oven or the baking equipments that were used by the baker, that does go into GDP, right. So, that means when you are talking about intermediate goods, the intermediate goods are excluded, but any intermediate good which is also a capital good, that means any kind of equipments, any kind of machineries, those get included under GDP, because the capital goods, spending on capital goods is actually investment expenditure. That means it is included under capital I. It is an investment of a business firm, so it should go into GDP. Similarly, for the farmer, let us say in the case of the wheat example, the intermediate good is the seeds that are used for growing wheat. The intermediate goods is the fertilizer, the intermediate good is the tractor that you use for farming. So, in this case, the wheats and the fertilizers will not get included because they are intermediate goods, but the tractor is a capital good, and although it is a resource, although it is an input, it still gets included in GDP because it is the farmer's investment towards farming. So the capital good, which is the tractor, gets included. So basically intermediate goods are excluded, but you can keep a note to yourself that all capital goods are included in GDP because capital goods are considered as investment for a business firm. So it classifies as capital I and it will get included in GDP because you know that GDP is C plus I plus G plus NX. So the I is there. So all capital goods get included under that I. The third exclusion from GDP are used goods. The used goods are not included in GDP. The reason being that once again, if you concentrate on the definition of GDP, it says it is the total value of all final goods and services produced within the borders of a country during this accounting period, right? During this year. The accounting period is usually 1 year. So GDP is only looking at the production of the current year, not the value of production in some other year. And the used goods are goods that were produced in another year and it's just being sold right now, right? So if you think about a used car, let's say in 2018, you are buying a 2010 car from someone, right? If you include the value of that sales into the 2018 GDP, then once again, you are risking double counting because the value of that new car in 2010 was already included in 2010 GDP. And now in 2018, again if you include the value of the car, then you are basically double counting its value. So to avoid that, we do not include any used goods, and that would be true even for houses. If you buy a used house from someone, then the value of that sales does not get included in the GDP. However, if you pay for any services, for example, if you pay for broker, real estate agent, or if you pay for a broker, or if you pay for, let's say in case of a car, if you pay for any money to the dealership, right, those values get included in the GDP. That money gets included in GDP because you're paying for the current services. You are getting the services of the real estate agent in 2018 and you're paying for his or her services, so that should go in GDP. So that means for any used goods, the value of the sales does not go into GDP. However, if you take the services of an agent or a brokerage or a dealership, then that does get included in GDP. Or if you make any additions to the good, right? For example, if you buy a used car and you get the car painted, then the value of the painting and the value of the painting services will get included in GDP. You buy an old house and you add a sunroom to it, then the cost of making the sunroom, that is a new addition, that will get included in GDP, but not the value of the actual transaction. Now, just as a digression, I want to talk about houses, right? It's a little bit tricky, the counting of houses in GDP. Now, there could be three options. You could buy a new house, a brand new house. It is built from the scratch. Nobody has lived in it earlier. So, it's a brand new house that you buy from the building company, right? Then the value of a new house obviously goes into GDP because it's a new good produced during this year. So, it goes into GDP. That's pretty straightforward. Now, for a used house, when you buy a used house, there could be two options, right? You either start living in the house yourself or you rent out the house, correct? Now, if you have a used house and you are living in the house yourself, that means it is an owner occupied house. In case of an owner occupied house, GDP includes the market value, the imputed market value of the rent. So, you might be living there. The value of the sales of the house does not get included in GDP because it's a used good. You are buying an old house. But what gets included in the GDP is the imputed market value of rent, because it is something like accounting for the services that gets delivered by the house. You are living in the house, so you are getting some service out of that house. So that service must get included in GDP. Now, there is no other way to get a value for that service other than computing for the market value, the market value of the rent for the house. You are living in your own house, so you are not paying rent to yourself. So how do I get a value of the services that you are getting from this house? Just go and get the imputed value of the market rent for the house and include it in the GDP, right? Now, if you buy a used house and you rent it out to someone else, then it is straightforward. Then you are getting the rent and the value of that rent goes into GDP, because basically you are earning that money as an income. It's a source of income, and also that money represents the services that are rendered by that house during that accounting period. So that goes into GDP, right? So for houses, please remember the value of a new house would go in directly. For used houses, there can be two things. It can be an owner occupied used house, or it can be a used house that is rented out. In both cases, the value of the sales, the value of the purchase of the house is not included because it's a used good. But in one case, the imputed value of market rent goes in for the owner occupied house, and in the other case, the value of the rent, the rental value of the house goes into the GDP of that year, because it is the value of the services that are given by the house during that accounting period. Now, the fourth exclusion from GDP are financial products, sale of financial products, something like stocks and bonds. Once again, the reason that those are excluded from GDP is because it is something like change of ownership. It is something like a used good, right? It's not a new good. If you buy the stocks of Amazon, then it is a change in ownership of that stock from Amazon to your name. Earlier, Amazon was the owner of that share. Now you are the owner of that share, right? So there has been no new good or service produced in the economy, but what has happened is really a change of ownership. So that did not go into GDP. However, to buy that same stock, if you use the services of a financial broker, a stock broker, then the money that you pay to the stock broker, the value of his services will go into GDP, because that is the money you are paying for the services that were delivered by him during this accounting period, during that year. That goes in. But the value of the sale, the money you pay for the stock, that does not go in, because it's just a change of ownership. The fifth exclusion from GDP is illegal or unreported activities. So it is important for the activity to get reported, for the production to get reported, and for it to be legal, for it to go into GDP. If nobody is reporting it, then it is basically in the underground economy, right? This might be a new term for you. Underground economy basically represents the illegal part of the economy, which is there but it is not getting reported, right? For example, a drug dealer selling drugs to college students maybe, right? That's an illegal activity. So nobody is reporting that. He is not paying taxes for his income, and the students are not going and reporting the purchase somewhere. So obviously they are not paying a sales tax or anything. So obviously that's not going into GDP. So any illegal activity does not get included in GDP. Any unreported activity does not get included in GDP. For example, I may be doing a legal stuff, right? I may be doing legal work, I may be nannying for a family, but I get my pay in terms of cash and I don't pay taxes out of it, right? So then I am not reporting this activity, right? So there is no way that this can get included in GDP. So it is important for the activity to be legal, and it is important for the legal activity to be reported for it to be included in GDP. If it is illegal and unreported, then it remains excluded from GDP. And the last and final exclusion from GDP is home production. Anything that you do within your own home, you cannot account for in the GDP, because remember, to get the value of something, it is important for you to know what is the price of something. And unless something goes through the market, unless something is bought and sold, it is difficult to get the price. For example, I may be growing vegetables in my own kitchen garden and I may be eating those vegetables every day. But if you ask me what is the value of those vegetables, well, the emotional value may be very high because, you know, I'm growing those myself, so I'm really emotionally attached to whatever I'm growing, but I don't know what is the real dollar value of those vegetables because I have not sold them in a market. So I don't know what price they would have sold at, right. So those kind of things do not get included in GDP, and it's not just about goods but also services, right. I may be making great dinner for my family every night, but I don't know how to include that in GDP because I'm not selling that dinner every night, right. I'm just making it out of love and concern and affection for my family, and they are enjoying it. So, you know, it has immense emotional value, but it does not have a market value because it's not going through the market, and hence it cannot get included in GDP. So once again, home production does not get excluded in GDP, and those would be the 6 categories for exclusion items from the GDP. From your exam and your quiz point of view, these are very important. There might be several questions which are based, which gives you really examples and tells you, okay, are these included in the GDP of USA, are these excluded in the GDP of USA. When we talk about the problem solving video, we will talk about some questions based on exclusions, and you will also see multiple questions in your practice set that talk about the exclusions from GDP. So all this discussion that we have just done, all that we have spoken about, the exclusions from GDP, the methods for calculating GDP, and how we came up with the GDP equation, the C plus I plus G plus NX equation, all that is based on getting the nominal GDP. So all that discussion was based on getting nominal GDP for a certain accounting period, let's say for 2018. And once again, the GDP, obviously it has a dollar value because every time you are including something in GDP is basically its value. So it is in terms of dollars. So if you look at the GDP numbers, if you just Google what is the nominal GDP of United States in 2018, you will just see a very big dollar number, maybe something like $17 trillion. Roughly it is $17 trillion right now for United States. So it's a dollar value, correct? Right. Let's say for 2018, let's make it simplistic and say this was $200 in 2018. Similarly, there is a nominal GDP number for every year. So you possibly have a nominal GDP number for 2017, and let's say that number was $100, right? Now, just by looking at these numbers, or let's say again in 2016, maybe this number was $50. Now, just by looking at these dollar values, can we really say that the GDP of United States has doubled between 2016 to 2017, and it has doubled from 2017 to 2018? Or can we say that the GDP number has quadrupled from 2016 to 2018? Can we really say that by looking at these numbers? Or can we say that the US economy has doubled in its production ability from 17 to 18, or quadrupled in its production ability from 16 to 18? Well, the answer is no, because what you're really doing is you are looking at the quantities that were produced in 2016 and you are multiplying them by the prices of 2016. Here you are taking the quantities that were produced in 2017, and let me remind you that this is not as simple as it looks. Here we are just doing quantity and price, but there are actually zillions and zillions of commodities and services that are produced. So every time you need to take the quantity and price for all those commodities and services and lump them together. So it's really a very abstract, very huge concept that we are looking at. But here we are just looking at the simplified version of it, right? So for 2017, it's the quantity of 2017 times the price of 2017. Similarly, for 2018, it's the quantities of 2018 times the prices of 2018, right? Now, I would be able to say that the United States has doubled it in its production ability only if I knew that these quantities that were produced have doubled, right? But what I'm trying to say is every year the quantity may have remained the same. For example, the quantity here may have been 50 and the price may have been $1. That could have given me the value 50. Here the quantity could have still remained 50, but what could have increased is the price, so that would give me the number 100. Once again, the quantity could have remained 50 and the price could have gone up to $4, so I could have got that number 200. So basically these numbers, the nominal GDP numbers, do not essentially mean that the quantities produced by the country, the quantity of final goods produced by the country during those years actually increased. The quantities could have remained the same, or the quantities could have gone down, and these numbers may have been triggered just by an increase in the prices. But the nominal GDP is not able to capture any of that. The nominal GDP just throws these lump sum numbers, and just by looking at those numbers, it may apparently seem that your economy is actually growing in its production ability, in its productive capacity. However, now as students of economics, you must take these numbers, the nominal GDP numbers, with a pinch of salt, because really the nominal GDP numbers do not tell you anything about the production capacity of a country. It just tells you that the country has got a bigger volume of sales, right? That is what it tells you. But it does not tell you whether that bigger volume of sales is essentially driven by the quantity, by a bigger quantity or not. It could just be driven by a higher price, right? So we need another measure of GDP which actually insulates the economy against these price fluctuations. In other words, something that adjusts for these changes in price over time, and that something is called the real GDP. Real GDP, abbreviated as RGDP. Okay. So what the RGDP basically does, it once again looks at the value of the good. So it still takes the quantity of the current year. So if you are doing RGDP for 2018, it's still taking the quantity of 2018, but it is using the prices of some reference year. So there is one particular reference year. So let's say this is using the prices of the year 2010. So that reference year is called the base year. So there is a reference year which is also called the base year. So real GDP is basically looking at the value of all final goods and services produced in the economy, but at the prices of the base year, right? Now let's go back to the same example. Let's do our GDP 2016 is 50. Our GDP 2017 is 100, and our GDP 2018 is 200, right? Now what this really means is we are taking the quantity of 2016 but multiplying it by the prices of the base year, which for us is 2010. We are taking the quantity of 2017 but once again multiplying it by the prices of the base year. We are taking the quantity of 2018 and multiplying it by the prices of the base year. So what have we done? We have basically insulated the economy against any price fluctuations, because every time we have taken the same reference price. So now whatever difference you see in these numbers must be 100% driven by the quantity changes, right? So because these prices remain the same, you may have quantity 50, price is 1. Here the price is also 1 and here the price is also 1 because it's the same price. So this number must be driven by the quantity change alone. So now we can say for sure by looking at the real GDP numbers that the country has doubled in its production ability from 2016 to 17 and quadrupled between 16 to 18, because we have referenced them to the prices of that same year. We have adjusted for the price fluctuations that have happened over time. So the real GDP is a better or a more superior indicator of the macroeconomic condition and the volume of production in a country than the nominal GDP, because the real GDP adjusts for these fluctuations in prices of goods and services over time, right. So you need to memorize, you really need to memorize the formulae for calculating the nominal GDP, the real GDP, and the percentage change in real GDP. I will put those here on the board for you. So you need to memorize these formulae for nominal GDP, real GDP, and percentage change in real GDP. So the first one is nominal GDP, the nominal GDP of any given year, whatever year it may be. It is the quantity of the given year, where Q stands for quantity, times the price of that same year, the price of that same year. But remember, it has to be aggregated for all goods or services produced in the economy. So what I am trying to say, if I am trying to find the nominal GDP of 2018, then I take the quantities of 2018 times the prices of 2018, multiply them. And if I have multiple commodities, maybe like pizza, salad, chips, then I take price times quantity for pizza, price times quantity for salad, price times quantity for burgers, whatever is produced, all the goods that are produced, and you add them up for 2018. You will get a clear picture of this when I go to the problem solving video. I will do numerical examples, but for now please understand what are the formulae that you need to kind of memorize and know. The real GDP for any given year is the quantity of that given year, so that part is still the same, times the price of the base year. Okay, and that base year could be any year, but it should be given to you in the question. The question will tell you what is the base year. Once again, aggregated for all goods and services produced in the economy. So if your economy is producing 10 goods and services, you need to do this for all 10 goods and add them up to get the real GDP. The third formula is the growth rate of real GDP, or the percentage change in real GDP. Why are we doing this? Because it is always, because these are really large, big numbers, right? Dollar values. So it is a little difficult to get this into perspective if you are comparing trillions of dollars. If you are saying, okay, the real GDP of United States in 2015 was $15 trillion and in 2018 it is $17 trillion, you are really working with a lot of zeros and big numbers, huge numbers, right? So we prefer to have percentage numbers because that is easy comparison, right? If we get a positive value, we say the economy has grown. If it's a negative value, we say the economy has disimproved, it has not grown, it has gone backwards. So percentage numbers are really easy to work with. So we find the growth rate of real GDPs. This is basically the percentage change. That is what we are trying to find here. It's a percentage number. So you just do the real GDP of year 2 minus real GDP of year 1 divided by the real GDP of year 1 times 100. That 100 is important because you are finding a rate, it's a percentage, so you need to multiply by 100. So what are we doing basically? If you are trying to find the growth rate of real GDP between any 2 years, let's say 2018 and 2015, right? So what you are doing is basically you are taking the real GDP of 2018 minus the real GDP of 2015 divided by the real GDP of 2015 times 100. That is what we are doing, right? So the more recent year is always your year 2, right? So the real GDP of the more recent year minus the previous year divided by the previous year times 100. That's your growth rate of real GDP. Now how do you calculate that? Once again, that same formula. The real GDP of 2018 would be the quantity of 2018 times the prices of the base year, whatever is the base year. Okay? That's the third formula. And the fourth formula that you need to know here is, what is the relationship basically between nominal and real GDP? What is the relationship? Now, if you take the ratio of nominal and real GDP, so if you do nominal GDP for any given year and divide it by the price, and divided by the real GDP of that given year. So, if you take a ratio between nominal and real of any given year, then you get a value capital P, and this capital P is also called the GDP deflator. The GDP deflator. So, the ratio between the nominal and the real GDP gives you a value which is called the GDP deflator. That GDP deflator is basically nothing but an indicator of the average price level in the economy. So, the GDP deflator is an indicator or index, you may call it an index. So, it is not a dollar value, okay? It is not a dollar value. You are basically dividing $1 by the other dollar value, so that gets cancelled out, and this is just a real number. So, it is an indicator or an index. An index is never a dollar value, it is always a number. Indicator or an index of average prices in the economy. So, in the economy you have zillions and zillions of goods and services that are produced. Which one do you choose as an indicator price? You really cannot pick and choose between commodities and services. So, this actually gives you an indicator of the goods and services, of the average prices of goods and services in the economy, right. So, the GDP deflator is the ratio of nominal and real GDP during a certain year, and it is an indicator of the average price level in the economy. Now, you must know these by heart. You should know these formulae by heart. Now, I am going to take some numerical problems on these when I go on to the problem solving, when you get the problem solving video. But before I end class today, I just want to work with some simple numbers and make sure you understand what we are trying to do here. So, next we are going to talk about a numerical problem and then work out these formulae based on that numerical problem. So, let us say we have an economy and we have 2018, 2015 and 2010 numbers given to me, and this economy produces computers, those are the goods, computers, it produces cell phones, and say it produces what else, let us say DVD players. So, those are the three commodities that are produced by this economy, and we have the quantities and the prices given to us. So, we have quantity and price for every year and for every commodity. So, quantity times price, quantity times price, times price, okay. And let us say we are also given the population of the country in those 3 years. So, we know what is the population. Okay, so let us say the quantities are and I am just cooking up these numbers once again. These could really have other values. let's say the population is 1000, 2500. Okay. And let's say this is the base year. So 2010 is the base year, so that information is given to me, right. So if I have to find the nominal GDP of 2018, I would basically do the quantity of 2018 times the price of 2018, but I would do that for all these three commodities. So I would do it for computers, I would do the same thing for cell phones, and I would do the same thing for DVD players, right, and add them up, because those are the three commodities that are produced in the country. So I would really take these numbers. So I would do 100 times 10 plus 300 times 20 plus 200 times 15. So just go by the first row, and I am adding, basically taking quantity times price for the three commodities and adding them up. So I am doing 100 times 10, that is for computers, plus 300 times 20, that is for cell phones, plus 200 times 15, that is for DVD players. And if I do that, then I get 1000, 6000 and 3000. If you add them up, then you get $10,000. That is the nominal GDP of 2018. Now, if I try to find the real GDP of 2018, the real GDP of 2018, then I am basically doing the quantity of 2018, but I am taking the prices of the base year, and my base year is 2010. So I am taking the prices of 2010, and I am doing that for computers. Once again, I am doing that for cell phones, and I am doing the same thing for DVD players and adding them up. Right. So the numbers that I am working with now is, I am taking the quantity of 2018. So it is still this quantity 100, that is the quantity, but now I am taking the prices of 2010. Still taking the quantity of 2018, taking the prices of 2010, still working with the quantity of 2018, taking the prices of 2010. So basically now I am multiplying 100 times 20 plus 300 times 15 plus 200 times 10. So that gives me 2000 plus 4500 plus 2000. So that would be dollar value 8500. Right. So you can see that the real GDP of 2018 is actually less than the nominal GDP. Right. So that's giving you a better picture. If I did the same thing, if I found out the real GDP for, let's say if I found out the real GDP for 2015, let me just wipe this out. Let me just remember the number for lack of space. Let me remember that this, the answer for this was 10,000. Let me remember that. Okay. Now let me work out what is the real GDP for 2015. So I would do quantity of 2015, but multiply it by the prices of 2010, because that's the base year, right? And I would do it for all the three commodities. So now I am taking the quantity of 2015. So that quantity, I am taking these quantities, and still multiplying them by those prices, right. So 200 times 20 plus 250 times 15 plus 100 times 10. So, that would be 4000 plus let us try to do this, 25 times 5, 125, 5, 12, 25 ones are 25 plus 12 would be 35, 37. I hope my numbers are correct, plus 1000. Wait. Okay. Now, if you add them up, then we are getting 8750. Okay. So, you can see how you can work with these numbers. Now, if you try to find out what is the percentage change, what is the growth rate in real GDP between these 2 years, 2018 and 2020, if you try 2015 and 2018, sorry. So, growth rate of our GDP between 2015 and 2018, then I just use the real GDP of the more recent year, that is 2018, minus the real GDP of 2015 divided by the real GDP of 2015 times 100. I already have the values calculated, so I just need to plug in those values. So, it is just 8500 minus 8750 divided by 8750 times 100. Okay. You can clearly see that you are going to get a negative number because you are taking away a bigger number 8750 from 8500. So, you end up getting a negative number, whatever that answer is. I do not have a calculator, so you can calculate your answer. Whatever that answer comes to, it is going to be a negative number and it is going to be a percentage value. So, that negative percentage value basically represents that your country has actually disimproved, it has gone backwards in terms of production ability from 2015 to 2018, and you get what is the percentage of degrowing, what is the percentage of disimprovement in the production ability. So, that negative number basically means that from 2015 to 2018 the country's production ability has actually disimproved. If it was a positive number, then it would be really improvement or growth. A negative number just shows disimprovement, nothing more than that. Okay. Now, similarly, I could find what is the GDP deflator for 2018. If I had to find out the GDP deflator for 2018, then I would simply take the nominal GDP of 2018, which is this, the 10,000, we have it here. If you remember the formula, GDP deflator is nominal divided by real for the year. So, that is the nominal for 2018 and the real for 2018 is given here, that is 8500. So, we would just divide these numbers. So, we would do 10,000 divided by 8500 and that would give me the GDP deflator for 2018. Okay. So, these formulae that we have are extremely important for you. You need to memorize these formulae. It will also be available to you in your lecture notes, and I will work through more numerical problems when we do the problem solving video, and you have more examples in your practice sets. So, hopefully, once you do all that, it will be clear to you. Next time we will come back to this chapter when we will wrap up this chapter. Next time we are going to talk about the indicators of prices in the economy, and we will also talk about another indicator, which is the real GDP per capita. So, next time we will talk about real GDP per capita and some indices of prices in the economy. Okay, thank you.